March 9th, 2009. The world didn't know it yet, but that morning marked the exact bottom of the global stock market after the worst financial collapse since the Great Depression. Banks were still bleeding, headlines were screaming fear, and millions of people were convinced the system was finished. But something strange was already happening beneath the surface, something almost invisible to the average investor, something that has repeated itself again and again throughout history. Because while stocks were still collapsing and confidence was still shattered, silver had quietly begun positioning itself for an explosion. And this pattern didn't start in 2009. It didn't start in 2008. It didn't even start in the modern financial era. It goes back centuries. Because every time markets crash, every time paper wealth evaporates, every time trust in institutions breaks, silver does the same thing. It disappears first, then it explodes later. The reason most people miss it is because they're looking at silver the wrong way. They think of it as just another commodity, just another metal, just a cheaper version of gold. But silver is something entirely different. It sits at the intersection of money, industry, and psychology. And during market crashes, those three forces collide violently, creating the conditions for explosive moves that almost nobody sees coming. When stocks crash, the first reaction isn't to buy silver, it's panic. Margin calls, forced selling, liquidation. Funds sell everything they can to raise cash, including gold and silver. This is why silver often drops hard during the initial phase of a crash, sometimes even harder than stocks. And this confuses people. They assume silver failed. They assume the thesis is wrong. But what they're really witnessing is the final purge before the system resets. Because crashes don't destroy money, they expose it. They reveal which assets are claims on wealth and which assets are the wealth itself. And historically speaking, silver has always been on the right side of that line. Every major market crash follows the same sequence. First, leverage unwinds. Then, confidence collapses. Then, governments step in. And when governments step in, they always choose the same solution. More money, more debt, more promises backed by nothing but faith. And that is the moment silver comes back from the dead. Because silver doesn't respond to optimism. It responds to desperation. It responds to broken trust. It responds to the realization that paper assets are only valuable as long as someone believes in them. And belief is the first thing that dies in a crash. Look at the 1970s. After the stock market collapsed in real terms and inflation spiraled out of control, silver went from around $1.50 an ounce to nearly $50. Not gradually, not politely, but violently, exploding in waves that caught almost everyone off guard. It wasn't because people suddenly loved silver jewelry. It was because the system had broken its promise. The dollar had been detached from gold. Inflation was stealing purchasing power silently, and people needed an anchor. Something real, something tangible, something that couldn't be printed. Silver filled that role perfectly. But what makes silver truly unique during crashes is its size, or more accurately, its lack of size. The silver market is tiny compared to stocks, bonds, real estate, or even gold. This means it doesn't take much capital to move it. When just a small fraction of frightened money starts looking for safety outside the system, silver doesn't absorb it smoothly. It reacts explosively, like a pressure cooker with a weak lid. This is why silver's moves aren't slow and steady. They're sudden, chaotic, and emotional. They happen when people least expect them, often after months or even years of boredom and suppression. And suppression is a key word here. Silver is one of the most manipulated markets in financial history. This isn't a conspiracy theory. It's a documented fact, with fines, lawsuits, and admissions from major banks. Why? Because silver is dangerous, not just financially, but symbolically. A rising silver price signals distrust in fiat currency. It signals inflation, it signals instability, and during a market crash, those signals are politically inconvenient. So silver is often held down artificially through paper contracts and derivatives that create the illusion of supply. But paper silver only works as long as nobody asks for the real thing. And crashes are exactly when people start asking questions. When markets crash, people don't want exposure, they want possession. They don't want ETFs, they want coins, bars, metal in hand. That's when the disconnect appears between the paper price and physical reality. Premiums rise, shelves empty, delivery times stretch, and suddenly the official price stops, meaning what people think it means. This happened in 2008, when silver fell sharply at first, only to triple in price over the next few years. It happened in 2020, when silver briefly crashed during the COVID panic, only to explode from around $12 to nearly $30 in a matter of months. Each time, the narrative was the same. People said silver was dead. People said it failed as a hedge, and each time silver waited patiently until the system revealed its hand. Because market crashes force authorities into a corner. They can't allow deflation, they can't allow debt to collapse, they can't allow markets to clear naturally, so they intervene. They cut rates, they print money, they expand balance sheets, and every single one of those actions is bullish for silver. Not immediately, but inevitably. Because silver doesn't front-run optimism, it front-runs reality. And the reality after a crash is always the same: a weaker currency, higher debt, and lower trust. There's another layer to this that most people miss. Silver isn't just money, it's infrastructure. It's essential to electronics, solar panels, medical devices, electric vehicles, and military technology. Unlike gold, silver gets consumed. It gets used up, thrown away, lost forever. This means above-ground supplies are shrinking, not growing. And during crashes, governments don't reduce industrial demand, they increase it. Stimulus packages, infrastructure spending, green energy transitions, all of them rely on silver. This creates a perfect storm where monetary demand and industrial demand rise at the same time, while supply struggles to keep up. This supply problem isn't theoretical. Most silver is mined as a byproduct of other metals like copper, zinc, and lead. So when economic slowdowns reduce base metal mining, silver supply drops even further, just as demand is heating up. This imbalance doesn't resolve gently. It resolves through price violently, suddenly, explosively. Psychologically, silver has another advantage: it's affordable. During crashes, gold often feels out of reach for average people, but silver feels accessible, tangible, something normal people can buy, stack, and hold. And when millions of small buyers move together, the effect is enormous because, again, the market is small. History shows that silver's biggest moves don't come from institutions at first. They come from the crowd, from fear-driven accumulation that starts quietly and then becomes a stampede. Once momentum starts and headlines flip from "silver is dead" to "silver is soaring," the same people who ignored it rush in late, amplifying the move even further. This is why silver charts after crashes look almost unreal. Vertical spikes, sharp pullbacks, emotional swings. Silver doesn't move on logic alone. It moves on human behavior under stress, and stress is exactly what market crashes produce. Here's the uncomfortable truth. Crashes don't end the system, they transform it. They justify changes that would never be accepted in calm times, and those changes always come at the cost of currency stability. Silver has been the mirror reflecting that cost for thousands of years. Empires rise and fall, currencies come and go, stock markets crash and recover, but silver remains, quietly repricing itself to match reality. The reason silver always explodes after market crashes isn't because it's magical. It's because crashes strip away illusions. They force people to confront what is real and what is promised. When that happens, silver stops being just a metal and starts being money again. Not officially, not legally, but psychologically. And psychology is the real engine of markets. So when the next crash comes, and history tells us it always does, silver will likely do what it has always done. First, confuse everyone, then disappear. Then, shock the world with a move that makes people ask the same question they always ask too late: how did we not see this coming? Thanks for watching. If you found this interesting, be sure to subscribe for more.